Hey, podcast listeners. Thanks so much for coming back for the zoo tour this week. I am Christopher Smith,
And I'm Robert Coburn.
and this is our educational segment on all things stocks and stock markets. This week, our topic is earnings reports.
So earnings are basically, what a lot of people, especially long-term investors like myself, mostly look forward to. I mean, short-term investors also look forward to it as well, but mostly in the short term. Whereas earnings for long-term investors like myself usually means better dividends in the long term and interest. But earnings are basically quite simply profits. So it's sometimes shortened to EPS, earnings per share, and that's usually means how much money per share do you earn for the stock. So it's usually the dividend will say like it's 5%, 10%, and so if the company's earnings per share uh, is usually determined by both the dividend and the price of the stock at that time. Now, earnings season is basically the time of year where stocks will or companies will report their quarterly earnings. So it happens 4 times a year. Uh, if you're a publicly traded company, you are legally required by the United States to report your financial results every 3 months, so every quarter. Now they don't have to stick to the calendar year traditional quarters. They can have their own fiscal calendars. So that's why you'll hear the term fiscal calendar, and that usually means that sometimes their calendar will fall, their end of year calendar will either fall in January, February, maybe even March. So basically, their fiscal year doesn't start until April, even though everyone else's regular year starts in January. And this is important because, earnings is important because this affects stock prices. Because usually, when there's any major news that comes out in terms of earnings, this will either cause the stock to go up or down. Also, any speculation regarding the earnings will also cause the stock to either go up or down. So, if there's a lot of hesitation around a stock, if there's a lot of pessimism about the company's performance over the last quarter, there will usually be a lot of people short selling the stock right before earnings. But if a lot of people feel that they had a really good quarter, they're gonna really blow it out of the water. A lot of the stock will usually go up a lot higher, and then kind of in most cases it'll have that buyer's high where it goes super high, and then it kind of levels off a little bit. So that's when also with short sellers that want to buy it at its peak and then wait for it to dip in the kind of in the hangover phase of the earnings report.
Yeah, the concept of earnings per share is really important because if you think about a company that reports, let's say, $10 million worth of earnings this quarter, if they only have a million shares of stock out there, then that's $10 per share. That would be really good. But if they have 10 million shares out there, then that's only $1 per share, right? So you have to pay attention not only to the total earnings of the company, but also to how many shares they have out there. You've got to divide the earnings by the number of shares in order to get the number of shares. Usually they do that math for you on the earnings report, but that's why, you've got to look at per share earnings rather than just total earnings. And that tells you sort of what your piece of the pie as a shareholder is. How much of uh, I mean, if you own a share of a company, you own a piece of that company. So you are looking at the earnings in order to find out sort of what return is the company getting on your share, your individual share per quarter. So if your share is, if you paid $10 for it and your share is returning, let's say 5 cents per quarter, you can sort of calculate the growth rate of your piece of the pie in that company. Um, so it's an important thing to look at. What kind of return are you getting on your equity? And it also lets you calculate what's called a PE ratio, which is the price to earnings ratio. What price are you paying for each cent or dollar of earnings? Um, and like I said, a lot of analyst agencies will make this calculation for you. Typically, I would say the average PE ratio in the market is about 15. So a PE that is higher than that is worse. A PE that's lower than that is better. But companies that are growing really fast will tend to have high PEs because people are sort of calculating out into the future that PE is going to come down as the company grows. Companies that are uh, shrinking, that are declining over time in their earnings, are going to have really low PEs because nobody wants to own that stock if its PE is just going to keep getting worse and worse over time. So PE doesn't necessarily predict the performance of the stock, but it can tell you kind of what kind of value are you getting? Are you getting in at a low price for the stock or a really high price for the stock? A lot of the mega cap companies like Amazon will have PEs in like 150 or 200, which are extremely high PEs. That tells you that those are really expensive companies to buy. But the reason they're so expensive is because investors are expecting the earnings to grow over the next several years. And so those PEs eventually should come more in line with the market. All right, we're going to go through this piece by piece. First of all, I want to talk about how to find out who reports earnings this week. So if you go into TradingView, which is my favorite analytics tool here, tradingview.com, over on the right-hand side here, you will see this little calendar icon. You can click on that calendar icon. And then down here, it says earnings calendar, and it will tell you each day who's reporting earnings that day. So Monday, we've got a couple banks. Tuesday here, we've got Community Bank. We've got a number more banks. So you can just keep scrolling down here, scrolling down until you find one you're interested in. Maybe you think Logitech, okay, I like tech stocks, so I'll do my research on Logitech and be ready for this earnings report on the 21st, right? So this is one way to do it. This will give you the full list of companies that are reporting earnings. Another way is to just Google, earnings this week, and you'll find lots of blogs and articles that will highlight just a few of the really important earnings that people are watching. So CNBC here is suggesting that you watch McDonald's, Amazon, Chipotle, Caterpillar, Boeing, and so that you can scroll down here and they'll have a list and they'll have some general information about things to watch for those earnings reports. So this is a nice way to get kind of the quick summary of which stocks to watch during earnings this week. All right, so once you've found a stock that you want to watch, like let's say Halliburton is a stock that we want to watch. The next thing that you might want to do to prepare for their earnings report this week is go to their investor website. So every company will have an investor relations page. So I've just typed Halliburton investor relations. We're going to search for that, and it will give me their investor relations page. So I'm going to click on that. And then when they announce their earnings report, you can see here they've got their third quarter earnings call and webcast scheduled for Monday, October 21st, 8 a.m. CST. So it's fairly important if you want to play earnings to both read the earnings report and listen to the conference call, because sometimes they'll report the written report will look good, but then the CEO will say something on the conference call that will make investors really pessimistic, and suddenly your investment that was green turns red because everybody has heard what he said on the conference call and jumps out of the stock. So those conference calls can be useful. Honestly, I usually don't listen to the conference calls. I just sort of read the reports. But the people who really play earnings are listening to those conference calls. So you'd want to come back at 8 a.m. Central Standard Time and listen to that conference call if you're interested in it. The other thing is here on their news and events page, they should release. Let's see, financial news. They'll release a a press release with their earnings results in it. And so if you want to find out the results, you'll have to come to their press release page and check that out. Now, you could subscribe to their RSS feed if you've got an RSS reader. And a lot of companies will also have an email alerts thing. So that lets you get the earnings report as soon as it comes out. If you can subscribe by email, that's the best thing. And it's a little bit different for every company. It doesn't look like Halliburton has a way to subscribe by email, but you just want to kind of like search their page there and see if you can find a way to subscribe to their press releases by email. Then you can get it delivered directly to your inbox as soon as the news comes out. And that lets you be the very first person to see that press release the moment it comes out, which gives you an advantage if you know how to evaluate these reports really quickly. You can potentially predict which way the stock is going to go, and you can get in before it makes most of its moves for the day. Now, once you've subscribed, the next thing that you want to do is start preparing. So you want to know what analysts are saying about what they're expecting in the earnings report. And there are a couple different companies that will let you do that. Fidelity has their earnings expectation page. Zacks is another one, and Yahoo Finance. These all have pretty detailed lists of earnings expectations. If I just go, let's just go to Google and type earnings consensus for Halliburton, and we'll pull up some results here. All right, so Yahoo Finance. Let's just look at the Yahoo Finance page for Halliburton. And it'll tell us analysts are expecting earnings of 34 cents per share in the upcoming report. Revenues are expected to be $5.84 billion. So these are the two numbers that investors who read the earnings report are looking for, the two most important numbers. So when that earnings report comes through, it's going to say Halliburton reports maybe 36 cents per share. And so I see, oh, 36 cents is higher than what the analysts were predicting. So that means the stock could go up today. And maybe revenues come in at $6 billion. So it has beaten analyst expectations on both earnings and revenues. That would be really bullish for that stock, and it's very likely that that stock would go up that day. Now, the other thing that could happen is maybe it comes in at 32 cents per share under the analyst expectations, and revenue comes in under analyst expectations too. Then I would expect the stock to drop. So if you know these numbers ahead of time and you get that earnings report into your email inbox, you can very quickly evaluate, are they reporting earnings that are in line with analyst expectations, or are they above or below analyst expectations? And that should roughly tell you how the stock is going to perform that day. Now, one of the things that can happen sometimes is earnings come in a little higher. They might come in at 36, but revenues are actually down a little bit. They might come in at 5.7. A mixed result like that can lead to wild volatility in the stock. So it might shoot up in the morning on news of an earnings beat, but then later in the day, as investors are looking at, oh, the revenues are lower, maybe that stock comes plummeting back down. It actually ends the day down from where it started. So a mixed result is one that you probably wouldn't want to play unless you're a day trader and you're looking for sort of wild swings within the space of just 24 hours, and you have a strategy for that. But most traders probably would not want to play a mixed result like that. You'd only want to play a surprise that comes, strongly in one direction or the other.
There's also the occurrence where they beat expectations in both earnings and revenue, but if the forecast, which they usually announce as well for like the next quarter, is like a really dismal or not as good as the previous quarter, this could also cause the stock to go down as well. So I mean, they could, knock it out of the park with revenue and the price per share, but if they have a really bad forecast for the next quarter, it could also impact the stock as well.
That's exactly right. In fact, that guidance is usually more important. The guidance for the next quarter is usually more important than this earnings surprise. This is sort of the first thing that people look for, this earnings surprise, because it's very easy to evaluate very quickly. But the guidance is ultimately more important because that's going to tell you about the future performance of the stock. So often you will see a stock that beats earnings and it beats revenue and it shoots up in the morning, but its guidance is actually lower than the market expects for the next quarter. And so then it comes plummeting back down. So that's the next thing that you got to look for. Unfortunately, this Yahoo Finance page isn't going to tell me what analysts are expecting for the next quarter. I did look at AMD earlier today, and I saw that Zacks has a pretty detailed list of estimates for AMD. So let's just scroll down here and look at AMD. So they give me a sales number. This is another number that investors are sometimes looking at. So for the current quarter, sales are estimated to be $1.8 billion. So then I would look at the earnings report and see if it's higher or lower than that. That's important. They give you the consensus earnings right here, 18 cents per share. If I keep scrolling down, it tells me, let's see, where are the quarterly estimates? Oh, okay. You gotta have a subscription, I guess. I was thinking, oh yeah, okay, next quarter. Here we go. So next quarter, the consensus estimate is 32 cents. So then I could look at the guidance section of AMD's earnings report and see, okay, the guidance that they're giving for next quarter is 34 cents. So they're actually expecting more next quarter than the analysts are expecting. So if their guidance beats these expectations for the future quarters, that would be another indication that I want to buy that stock, that it's going to grow faster than analysts expect it to grow over the next, several quarters. So you got to look not only at the reported earnings for this quarter, but also at the company's forecast for future quarters, and you got to have some idea what analysts are expecting for the future quarters. So the stocks that are best to play at earnings are the stocks where you can get sort of the most complete picture of what analysts are expecting. If you get a stock that there's no consensus estimate for that stock, which sometimes happens with the really small cap stocks that are more obscure, those are really hard to evaluate on an earnings report because if you don't have any sort of benchmark to compare against, then you don't really know, where the stock should be versus where it is. So I like to play sort of the mega cap companies, the really big companies that have high volume and a lot of analyst interest, because it gives me a lot of benchmarks to compare against as I'm trying to evaluate the earnings report. The other thing is some investors will buy the stock ahead of earnings and just sort of guess which way it's going to go. And this number right here is something that Zacks puts together. It's called the earnings ESP. That stands for expected surprise prediction. It will be either green or red. If it's red, it means they're expecting the earnings to miss estimates. And if it's green, it means they're expecting the earnings to beat estimates. So based on their proprietary algorithm, they've calculated that AMD has a 6.5% chance of beating analyst estimates. That's not a huge chance of beating analyst estimates, but it's pretty significant if you're, sort of an institutional adventurer who's playing the large numbers game. So a lot of traders who trade on a regular basis are trading partly based on this earnings ESP, and ahead of earnings, sometimes a positive earnings ESP from Zach can cause the stock to go up ahead of earnings. So one of the ways that you could play is as soon as this earnings ESP turns green, you could buy that stock and kind of write it up ahead of the earnings, and then you could exit the stock right before the earnings report. So those are a few things to look at as you're sort of getting ready for an earnings report to come out. Now, once an earnings report comes out, it's pretty advanced to try to read it yourself. But if you don't want to try to interpret the earnings report yourself, you could come over to Fidelity. And let's just pick one from this week. Let's see. TSM, Taiwan Semiconductor, reported earnings this week. So Fidelity has this section here called CUSIP. It's going to give you full detailed analysis of the stock. So I just typed the ticker into this box up here and then logged in, and it's going to give me news in this box here. Full elaborate news on the stock. If I hit more here, I'll get the full list. And we can see it reported this last week on the 19th or 20th. Sorry, I guess it was more the 17th. Okay, so here I've got a news article here. These DJ time real time news tend to come out pretty much immediately after the company issues its press release. So these happen really quick. Also, MT Newswires is another one here that is going to give me a quick and dirty summary. So as soon as I see that earnings report arrive in my inbox, I could just come over here to Fidelity and I could click on one of these headlines. So MT Newswires tells me that they reported pre-market Thursday diluted earnings of $3.90 per share, total sales. It's going to give me like the key numbers in a really compact form. And for Q4, it's also going to give me the guidance numbers for next quarter. So the company expects revenue to be between 10.2 and 10.3 billion. So if I know what analysts are expecting on the earnings report, this gives me the quick summary of the major numbers in that earnings report. Then let's go back and look at the DJ News here. DJ News is going to give me a little bit more detailed analysis. They're not just going to give me the raw numbers. They're going to give me sort of, was it better than expected or was it worse than expected? We can see Taiwan Semiconductors was better than expected third quarter earnings. They're going to give me some highlights from the report. And I can see 62 cents was their report versus 60 cents analyst consensus. So it's not a huge beat, but it's a significant beat. They had 9.4 billion sales above the 9.2 billion analyst estimate. So they beat on sales as well as on earnings. So good stuff here. Nice highlights. I would see this and say, okay, maybe I should buy Taiwan Semiconductor. So that's kind of a nice way to get a quick summary of the news if you've got a Fidelity account. If you don't have a Fidelity account, you're probably going to have to go to places like Yahoo Finance or other news agencies that tend to lag a little bit longer. They take a little bit longer to post their analyses of earnings reports, but you can get in, maybe an hour later, and they'll have a nice analysis of how the actual numbers compare to the analyst estimates on something like a Yahoo Finance. Now, once I've got the numbers and the headlines, and I know sort of how the company has come down compared to analyst expectations, then I have to decide, whether I'm going to buy or sell. And the risk of buying on earnings reports is that they will do counterintuitive things. So if a stock beats analyst estimates on earnings, and it beats analyst estimates on revenues, and it reports good guidance for the next quarter, ordinarily I would expect that stock to shoot up. But sometimes they do the opposite. Sometimes they shoot down. And that's just one of the risks that you take when you play these earnings reports, is stocks can be weird about earnings. And part of that is if a stock gets, what has the stock been doing before the earnings report? So if a stock has been going down, then it could have a really positive reaction to the earnings report. Whereas with this Taiwan Semiconductor, which is one of the ones that I was watching this week, if I pull up the chart here, I can see it was going up before the earnings report. And so the market was really optimistic going into earnings. Everybody expected it to beat the analyst estimates, and it did beat the analyst estimates, but maybe it didn't beat the analyst estimates by as much as everyone wanted it to. And so it actually came down after the earnings report, and it's on its way down. So as an investor, you could buy immediately as the report comes out, or you could watch to see what the stock does afterward. I like to call this the wrong way earnings play, and this is my favorite way to play earnings. So I don't buy right when the report comes out. I read the earnings report, I make my own evaluation of it, and then I see what the stock does. And if it's a really good earnings report and then the stock comes down, then I see that as a buying opportunity. So I try to buy the dip. I try to pick the bottom. Because a stock that had a really good earnings report is going to come back up eventually. I have some confidence of that. But the question is, when is it going to hit bottom? So I've identified some support levels. I've identified some trend lines. All of these are places that the stock could bounce from. So when the stock comes down to this first support level here, I might buy it. And then it comes up a little bit,
And then if it shows some weakness here, I might sell it. And then it might come down to this trend line and I'd buy it again. And then it might bounce again. See, so you've got to just kind of try to pick the bottom. Usually the way that I do this is I scale in. So I'll buy a little bit here, and then at the next support level, I'll triple my position, and then at the next support level, I'll triple my position again. So I've always got most of my position at the lowest price. So my average price would be, somewhere in here if I do it that way. So you kind of scale in and you make sure that you always have enough cash to triple your position several more times if the stock keeps coming down. And that makes sure that you have a pretty low average price for the shares that you bought. That's the way that I like to play these. Typically, if it breaks across this downward blue trend line right here, that's bullish for the stock, but it might still come down some more. So if it were to cross this trend line and then come down some more, I would draw another trend line here. Maybe I would adjust this trend line like that if it topped out right here. And then I would watch for the next trend line cross. And that would tell me sort of what the stock is going to do in the long term. So wrong way trend line plays are probably one of the safer ways to play a really good earnings report. Rather than immediately taking the risk by buying in on the earnings report, you wait for the next really big dip and then you buy that stock.
All right. That's how to play earnings reports. Make sure that you always take account of the risks. This is definitely, earnings reports are a volatile time for stocks. So if you're not excited about taking big risks with your money, you probably shouldn't play stocks around their earnings time. This is definitely when you get the most movement in the market. So you've got the most potential reward, but you also have the most potential risk. And we saw that with Netflix. Netflix shot up about 8%. A lot of people bought in because they were really excited about the Netflix earnings. And then Netflix took a tumble and it's down, I think, like 15% from where it hit its high right after the earnings report. So you got to watch out for that volatility around earnings time. And just be careful out there, guys. Don't spend your grocery money on trading these things. If you're going to play this, make sure that it's play money and that you can afford to lose it for a little while. Make sure that you play stocks with really strong earnings, really strong guidance, and it should come back up eventually.
Yeah, and one more thing I'd like to add is that for long-term investors, if you consistently see a company that is beating expectations, is really doing good on forecasts, usually you don't really need to concentrate on the short-term in terms of the immediate reaction to the market, as usually over time, as with most stocks, they do tend to go up over time. So especially if the company is just consistently just knocking it out each quarter, the long-term play is usually always gonna beat out not necessarily we're always gonna beat the short-term players like Chris here, but if you're just gonna put your money in and just sit and wait, it's going to last. It's a lot less risk than playing the quarterly earnings.
That's exactly right. And in fact, let me just show you how to do that. So this Fidelity snapshot really has a lot of useful information on stocks. This earnings section right here is important to look at. So this is going to tell you over the history of the stock, how often has it beaten earnings? This gray bar here is the analyst estimate, and the blue bar is the actual. So you can see Q4 of 2017, it beat the analyst estimate. Q1 of 2018, it slightly missed. Here it was in line with estimates for 3 quarters. Then we had a beat, and then it was in line again. So Taiwan Semiconductors doesn't have a really strong history of beating analyst estimates. If you look at some other stocks, you will find, maybe for the last 8 quarters, they have beat analyst estimates. So that would be a company that has a really strong history of beating analyst estimates, and they're quite likely to do it again. So if you see a company like that, that's a company that's really great for a long-term buy and hold, because even if one earnings report should go badly, over the long term, they probably will beat analyst estimates more often than not. And so that stock should get a lot of nice bumps every time it reports earnings. So that would be a really good long-term buy and hold. The other thing that the long-term buy and hold investor should pay attention to on earnings reports, Roberts, is cash flow and debt. So a company that has a large cash reserve is going to be a lot more robust if, like, let's say somebody files a $50 million lawsuit against it. If the company only has $1 million in cash, that lawsuit could kill the company. But if the company has $1 billion in cash, then a $50 million lawsuit is a fly that they're just going to swat away. So you got to look at the cash reserve. The other thing is you've got to look at the debt. So if a company, let's say they have 4 times more debt than cash, they may not have enough cash to pay all of their debts. They may have to issue new shares in order to raise new capital, which will dilute your share of the your ownership share of the company. So new share offerings are bad. We want to avoid that. If a company has a lot of debt and not a lot of cash, that makes things like new share offerings more likely. It makes your risk a lot greater. So when you look at those earnings reports, it's important to look at what's their cash flow. Do they have a lot of padding in case they should have a major event that's bad for the company? Are they going to be resilient against that? Or do they have so much debt that, a lawsuit like that could totally put the company out of business, make it go bankrupt? So you really got to pay attention to those debt and cash flow levels as a long-term investor to minimize your risk. Hey, thanks guys for watching another Zoo Tour educational episode. Please like and support our podcast. Subscribe on YouTube. We're also going to issue on Podbean and iTunes our news segment, our weekly news segment. So you can look for those. Give us a rating on iTunes. And you can sign up for Webull using our referral link underneath this video on YouTube. Share it with your friends. Tweet at us at WSPZoo, and like our Wall Street Petting Zoo page on Facebook. And thanks so much for listening. Your support is what keeps this podcast alive. Signing off. See you next week at the zoo.